lots of people say that the wicks do the damage and the body tells the story. But each body, sure, like the body shows the sediment of the candle, right? So it shows like the per se like buyers and sellers in the market, and the or like it more shows like how much liquidity is located on the left of the chart. So like if there's like a little bit of liquidity or no liquidity at all located on the left of the chart, so it's all a balanced market all the way up on the previous range, whatever, like down and now it's traveling down and now it's traveling up. That liquidity, if there was no liquidity, then you would have like big range candles. But if there was liquidity being grabbed and stuff, then you would have smaller range candles. So with so really you can't get a good picture of like the story being told with the bodies of the candles. Rather, you have to go to the wicks of the candles. The wicks of the candles show like a lot. Like, so if you have a green candle and you have a wick projection to the bullish side, that's going to be pushing liquidity up. If you have a green candle with a wick projection to the bearish side, that's going to be grabbing liquidity. If you have a red candle with a wick rejection to the bearish side, that's going to be pushing liquidity down. And then if you have a red candle with a wick rejection to the bullish side, that's going to be grabbing liquidity. So if you're moving in a bullish trend, it's, let's say you have like a red candle with a wick projection to the bullish side, that's going to be grabbing liquidity, right? So it's going to be grabbing sell side liquidity, and then when price travels through it, it's going to stop out all the sellers. And now if price and trades back through that point, it's going to refill with sellers if it hasn't been specifically tested. So it's like complexity, but like complexity then leads to, you know, it getting easier and easier, because like the market's complex. You have to understand that the market's complex, so you have to take your mind into a place of complexity. And if you don't, then you're kind of not following the market for actually like what it is. And then if you have, let's say, a long wick rejection to one side of the candle, so let's say you have a red candle, so you have a red candle and then you have a wick rejection down to the bearish side, and that wick rejection exceeds the length of the actual candle in a way further. So let's say you have that red candle with the wick rejection down to the bearish side, and the wick rejection to the bearish side is way longer than the actual candle body itself. That then would mean the opposite meaning. So rather than because the wick rejection down to the bearish side shows that shorts are being offered price. So because that wick projection is longer than the body of the candle, it actually shows us that longs are being offered price. So it shows us the opposite meaning. So for example, if you're in a bearish trend and you see a bunch of wick projection down to the bearish side coming whatever into a previous range, and whatever you have like liquidity located right there, that then would be like a confirmation that the price could reverse, right? But those wick projections have to be longer, and if they're not longer than the candle, usually like they have to be like at least the candle length, but I always like them to be like at least like probably like 1.3 to 1.5 times the candle body to actually make sense. But yeah, I go through all of the like the wick meanings on Instagram. So go follow me over there. So for example, like a green candle with a wick rejection to the bullish side is going to mean, or is going to show that retail shorts were offer price. So if retail shorts were offer price, then pricing to push up through there, and there's going to be no resistance for price then to push up through there. But if we have that same candle, but the wick is longer than the body, then it would actually show that retail longs are being offered price. And if retail longs are being offered price, they don't want to push them above their entry. So what's going to happen? We're then going to see a red candle print next to then stop them out, right? Because even if it's just one red candle, just to stop them out and then to continue the price higher, because we know that retail minded traders are very easily persuadable. So if you see, and like they trade off of their emotions, so they'll trade off fear and greed. So if they're fearful, right? So if they're within profit, they're greedy and they want to overextend their profit. And then if they're fearful, they cut their losses really quickly. So like, for example, or sometimes even they could be greedy within cutting their losses and not cut their losses. It really depends on context, right? So you just run scenarios through the charts, and you'll start to find like, oh, this makes sense. Like, but so, for example, and then yeah, so I explained the green candle with a wick rejection to the bull side shows that retail shorts are being offered price. If we have a green candle with a wick rejection down to the bear side, that would tell us that retail longs are being offered price. Retail longs are being offered price. They put their stop loss below that candle or below that wick rejection. That then would tell us that, okay, high probability that we then get price to come back to stop them out, right? And then a red candle with a wick rejection to the bull side would tell us that retail longs are being offered price, right? So it's the opposite as the green candles. And then a red candle with a wick rejection down to the bearish side would show us that retail shorts are being offered price. So if price then trades back to that area, that then would trigger in short positions to enter in the market. So that's every time. That's why like you'll see within the market when you have a red candle with a long wick rejection down to the bearish side, right? Price will trade into that wick rejection or even trade below it, and then you'll see a reaction, right? Because that's a draw on liquidity. So red candles with a wick rejection down to the bear side is draw on liquidity, and then green candles with wick rejections to the bull side is draw on liquidity, because the green candles with the wick rejection to the bull side is draw on liquidity, because the fact that retail shorts were being offered price, look at it right there. So if retail shorts are being offered price, look at it right there, then, or wait, because let me think, because if retail shorts were being offered price, then there wouldn't be, you wouldn't want to offer them price again, right? So rather it would be a red candle that they would want to push price to. So both, so when you're pushing to the bullish side, the draw on liquidity would actually be a red candle to the bullish side, right? Because that's going to be an area where retail, well, it really depends. Because if price gets extended above a wick rejection with a if price gets extended above a green candle with a wick rejection to the bullish side, retail sees it as like a short squeeze, and then they want to long the market. So think, okay, if they know, if they're thinking that, then smart money is going to think the opposite, and they're going to think, okay, we know that they're going to enter around this area. What we need to do is extend the market up and then crash the market down because they enter long. Now, if they enter long, smart money pushes price down, or smart money really doesn't push price down. All they have to do is participate within the parameters of the algorithm, and then price will then push down, right? So if we're thinking about that, then okay, price runs above a green wick rejection to the bullish side within a bullish trend, right? Because and that would be seen as like a short squeeze. And then wick rejections to the bullish side with red candles that are balanced and don't need to be ran above would be sell side liquidity located within that candle. So it would be sell side limit orders located within that candle. So there would be smart money and also other traders that want to smart money like smart money or traders that trade with smart money. That's where their orders are going to be located, as well as smart money, obviously. So that's where their orders would be located. But yeah.